going to bring on Jason Bible. Jason is a little experienced in a little experience in real estate. He's flipped 200 or 300 houses. He's super knowledgeable, especially with data. And what we're going to be talking about is real estate and this low interest environment, which we've been in this season, low interest season in our, I say season from a big macro standpoint and timeline in the U.S. economy, but we've been in this season for a while, but things have just gotten even better. It's like when you don't think it's going to get any better, then we start going below 3%. And so I brought Jason on board to talk about what that's going to do to the real estate market in the near term, kind of what we're seeing over the next few years, and how you can use that to benefit your business, specifically how to invest and pivot and take advantage of this market. So I'm going to turn it over to you, Jason.
Well, Chris, I want to say first, thanks for having me on. I really appreciate it. I haven't spoken for other group in a while. And like you said, it's, and I think Rob was talking about it too. Rob and I work real closely together over at Jet. Rob, how much did we do last month with Jet? It's ridiculous.
Last month, I think it was, $1.5 million? $1.5
million, 2 million. It was whatever it was. It was big. We did a couple small apartments and some other smaller deals, and yeah, we did a bunch of stuff with you guys. So we're buying. And you guys are buying too, right? Like Eddie's still buying, your investors are still buying, like everybody's still buying, right?
I've got a 4-house package out there right now that a couple of people bid on, but I mean, he wants $1 million for them. 4-house package.
Oh, I saw that.
Yeah, it's a pretty good deal.
So the reality is that if people are waiting, if investors are waiting for the crash of the marketplace, it's not here. Like there's no crash coming. Like there's no data out there anywhere that says a crash is coming.
No.
In fact, let me try this, Chris, if I can do a screen share. Rates are at like record lows. Oh, perfect. All right, I got it. So, I mean, this is the reality of the marketplace right now. And the question I get from a lot of investors is, well, Jason, when's the other shoe going to drop and the world's all going to fall apart? And I'm like, look, dude, maybe you missed it. But we essentially closed the U.S. economy from March until about May. 90% of GDP was sitting at home watching the Tiger Show on Netflix. Like, we closed the world for 8 weeks, and this was the result. In fact, if I can give you any bit of advice, the most important asset in real estate is not commercial, it's not triple net leases, it's not Class A apartments, it's the single family home. That has become the most important piece of real estate in the world. And if the analytics I'm reading are right, that's not going to change anytime soon. In fact, I'm going to keep going, but if you guys want to add questions into the comments and questions section, I'll address those as they come across. But one of the things I've heard since literally I turned 42 this year, and I've heard this ever since I was old enough to hear about Paul Volcker, and that is, Jason, you don't understand, interest rates are going to go back up. They're going to go, I'm telling you, they're going to come back up. They're going to be 10, 12, 13, 14, 15% on a 30-year fixed rate mortgage. And I keep telling folks, I'm 42 and I've not seen that in my lifetime. I think that world is gone. In fact, if there's anything, debt is cheap. I do a 3-day-a-week show. I shouldn't say show. It's really like a webinar on market updates, like what's going on in the marketplace and that sort of thing. And one of the articles I showed from Monday night or Monday at noon was that 60% of the world's debt yields 1% return or less. So debt is cheap. It's real cheap, and it's not going to get any more expensive. I'm just not seeing it. I see Robert Kiyosaki out there waiting for the crash of the dollar. I'm a big fan of Peter Schiff. he's waiting for the crash of the dollar, and I'm like, boys, it ain't happening anytime soon. I'd be remiss to say not in my lifetime, because I hope I live a long time. So who knows? In the next 20 years, there's no crash of the dollar. What other currency do you trust? That's the bigger question. A lot of people say, oh, I'm going to go invest in gold. And I'm like, so what is gold backed by? Gold's a rock. Gold's been essentially flat until most recently for almost 10 years. It's like there's no return there. You know, there I'm hearing Bitcoin and all this other nonsense. And I'm like, look, the only thing that has made sense for me for the last almost 10 years now is real estate. And I welcome any of the challenges that somebody says, maybe real estate's not a great investment. I'd love to have that conversation. But one of the fantastic things about real estate is it's self-collateralizing, meaning I can look at a house I'm going to buy, maybe it needs some work, going to rehab it, going to put it back on the market for rent or for resale. And then the house next door sold for $300,000 and the house next door to that sold for $305,000. So what's the house worth? Probably worth about $300,000. That's what self-collateralization means. As opposed to starting another business venture where if I have to borrow debt, that debt I have to convince a bank that, you know, my restaurant's worth $500,000 or my lemonade stand is worth $200,000. Not so in real estate. It's pretty clear what these things are worth. So I'm really not buying into the narrative that the world is crashing and it's all doom and gloom. And you can see right here, rates are all at record lows, with exception to the jumbo 30-year fixed rate mortgage. All these things are at 52-week lows. Now, keep in mind, this is wholesale rates. This may not be what you get on the street. This is wholesale rates. This is like looking at wholesale rates for buying a car. Like this is just what it costs, you know, for them to actually lend to the bank. So they're just at all-time lows. If you look at, and I don't know, I'm going to assume, Chris, most of your audience is here in Houston. This HAR report is extremely instructive on what's going on in the marketplace. Keep in mind, this is important when I'm talking about COVID data, because it's very relatable to what's going on in real estate. In that, I don't know how much you guys have been around town. I'm out nearly every night of the week, going out tonight. In fact, I'm going to a buddy's house, so I'm not really like going out, but going over to a buddy's house. Go to a restaurant. There's nobody in restaurants. Even in the Heights. We'll go to a restaurant here in the Heights. There's 10 people in the whole restaurant. We'll go, I mean, I was in Mexico 2 weekends ago. Nobody on the plane. There's nobody in the airport. Still, nobody in the airport. Flew down to Mexico, had a fantastic time. Nobody down there. Flew back, nobody on the way back. I mean, just nobody is out. Yet, when I look at data like this, they're still buying houses. It's very interesting. The most important piece here are these two things. Single-family home sales are up 16%. Total active listings are down 18%. That's a net delta. The difference between those numbers is almost 40%. So what does that mean? If you think real estate's expensive now, just wait. That is pent-up demand with an extreme reduction in supply at the same time. It's very rare to see that in an asset class like single family in a market this big. Here's another sign. Single family months of inventory plummeted. I don't know why HAR chooses to report this as 1.1 months. What they really should report this as 40%. There's a 40% reduction in inventory. I'll tell you right now, if you were an investor in the stock market and there was a 40% reduction in the number of shares in the S&P 500, that market would jump up by 60% overnight. That's what's happening in real estate. It just happens a lot slower. And then you can see single family home sales are up 40%. Mix this with an environment that has historic lows in interest rates, and it's a recipe for massive, massive price appreciation, especially at this price point or below. The median home sales price and below, that $262,000 and below, is going to see massive price appreciation. Really is. It's again, I've been pounding this drum for 2 years now. And if you guys have been in this more than 10 minutes, you've already seen it. Those of you who've been in this business for, let's say, 5 years. In fact, if you've not been in the industry, but you've lived in Houston for, let's say, over 5 years, go back and look at the house in the neighborhood that you and your spouse first moved into and pull up your HAR app and see what those houses are selling for now. It will blow you away how expensive starter homes have gotten in the United States, and in particular, Texas. And I'll tell you the other amazing thing that's happened. If you guys have been watching the whole Elon Musk story, one of the reasons we've been following that so closely is that Elon ain't the only rich guy that's looking around where he's at and saying, you know, I don't think Fremont, California is a great place for me to do business anymore. And let's be honest, building trucks and semis is a much more Texas thing than it is Southern California. In fact, they're talking about building the Model Y here as well and servicing not only the central part of the United States, but also the East Coast. So he's not the only one that's going to move here. And there's a fantastic Texas story that's evolving right now. And if you're waiting to get into real estate, there's literally no more perfect time. If you're waiting for a crash, it's not going to happen. There's no data out there that says it's going to happen. I mean, it's just going to be a ridiculous environment. So I'm going to show you one more graph, and then we can take some questions here. This will be in the next 5 years. You will begin to see this thing on MSNBC, or maybe you won't. Hold on one second. This will be the most important graph that you'll see on MSNBC and all those other channels. This is median new home sales price by number of new homes built. The green line is median sales price. The red line is total new home sales. And they sell almost every one they build. So it's not like there's shadow inventory of new homes out there. And you could see starting in 2006. Now, mind you, and this might be kind of hard to read, but this chart starts in 1990 and is current through about halfway through Q1 2020. There's been an enormous disconnect between the number of properties that were built versus the number of properties sold. What does this mean? The only way, there's two ways you put houses available for sale in a marketplace. One is you build them. Two is existing homeowners put their houses on the market. And although we've been through some really turbulent times, you'll see here that new construction has not caught up with demand. And it's only going to make houses more expensive. It's gotten so bad that Section 8 in some markets is building homes. The pilot program is in Corpus Christi. We saw that about a year and a half ago. We went down there, met with the guy that runs the Section 8 office in those two counties, and he said, I've got a 5,000 family waiting list for housing. And I'm like, are you kidding me? He said, it's gotten so bad. We have a pilot project for building new homes, buying infill lots at tax sales, at trustee sales, and building new homes. And we asked him, we said, well, I mean, when does that start? Like 5 years from now? And he said, no, you want to see the first one? It's already done. We went out there and looked at it. Beautiful 3-2 house. 3-2, 1,600 square feet. It's very standard brick, sticks with bricks, all very durable countertops. It was finished foundation. Didn't have real flooring in it. It was stained concrete. I mean, it was like the classic landlord product. So the reality is that real estate's just going to get more expensive. So if all you guys are waiting on the sidelines to figure out, should I get into real estate, should I not? You've got about a 24-month window, and then it's over. Like, there's no crash coming. There's all these forbearances. The forbearances are at least a year out, and those houses will appreciate at another 10, 12%. And then the people that couldn't afford those houses are just going to put them on the market and sell them. It's not like 2008. It's still very relatively difficult as compared to pre-2008 for someone to get a home loan. So that's kind of my thoughts here. Let me pull up, I saw a handful of folks that had, looks like questions here. Let's take a look in the chat. What happens after the elections? Money cannot get cheaper, right? Will there even be any effect at all? Where did the supply go? All right, what happens after the elections? I got to tell you, Trump ain't looking good. And regardless of who the actual Democrat nominee is, I'm going to end up voting for Trump again. But I'll tell you what, it is not looking good for Donald Trump. I've been watching a lot of Ben Shapiro's recent broadcasts on YouTube and on his podcast. And, a lot of people say, well, you can't trust the polls. And Shapiro said, yeah, well, that's actually not true. The last election, if you looked at the national polling data, it was actually right. The state data wasn't. And even early on, there were some indications that Trump may have won those states. He said that is not the case right now. National polling data looks just bloody, and so does the state. states. So right now, unless something changes and Donald Trump decides to start managing this coronavirus thing a little bit better, we may be looking at a Biden presidency. In fact, we were talking at breakfast this morning. If Biden selects somebody like Michelle Obama as VP, this election's over before it even started. However, there's a silver lining here, and that is if the Democrats win, I don't see Fannie and Freddie going back into the private sector. I think the federal government's going to continue to own them. In fact, I think if you looked at Democratic administrations in the past, especially if they take the Senate, it's going to mean more opportunity for more people to buy houses, which really just means really relaxed lending standards. So we're going to do well on that front. Now, with regards to taxes, we're going to get murdered on taxes. They're already talking about getting rid of the 1031 exchange. There has been talk for 2 decades now about starting to tax IRAs. That could be on the table. I mean, we just don't know. Now, if Trump does win re-election, I think the GSEs come out of receivership and go back into the private sector, so rates are going to go up, and hopefully we'll enter into another relatively tax-free environment, if you will. But I can tell you I'm not real confident that Trump is going to win, or we're even going to keep the Senate, just to be completely honest. It's the data, the real ground level data looks really ugly. And it's got nothing to do with mail-in voting and all other stuff. Just the way they've handled this has just not been great. So that's, next question is, money can't get cheaper, right? Could. It absolutely could. There has never been in the history of the Federal Reserve, and the Federal Reserve talks through what's called the FOMC, the Federal Open Markets Committee. That's a committee that has conversations about rates and that sort of thing. They have floated negative interest rates for almost 8 months now. We can absolutely see rates lower than that. You know, let me go back to when I was talking earlier about Monday, when I gave a presentation to our group on Monday. Global debt, 60% of global debt is 1% or less. So could we see rates lower? Absolutely. Oh, absolutely. We could totally see them lower. Let's see. Will there even be an effect at all? I think there will. Where did the supply go? Great question. Where did the supply go? I've got it. I don't have it on cue here, but I've got a PowerPoint presentation somewhere that shows the number of houses sold in Houston, Texas. Essentially, it doubled every 10 years, with exception to the last 10 years. Where did the supply go? We don't have any more supply. We're running out of land that we can affordably develop into single-family real estate. That's why I believe you're going to continue to see the prices increase over the next handful of years. Mark Dotzauer, I caught a presentation of his with a Sotheby's office in Central Texas. This was right after the crisis started, I want to say mid-April. And one of the things Dotzauer said is, in order for you to see price reductions in real estate, you have to have at least 10 months of inventory on the market. And he said, I know this is almost absolutely true because we have 40 years worth of data in Texas that shows that to be true. And if we're at, and I have to pull the number back up, 3.1? Let me look at it here. We're at 3.2 months of inventory. The amount of inventory would have to increase 3 times in order to even start discussing price reductions. We need a 2008 real estate crash times 5 to get to a buyer's market. That's why I keep telling folks, like, if you're waiting for a crash, like, it's not going to happen. Like, statistically, like, Iran would have to nuke half of the United States. I mean, it's so, like, the scenarios are so absurd. Like, it doesn't even make sense, right? Iran would have to nuke half the United States. We'd have to figure out Trump's really colluding with Russia. I mean, it's like, I don't even know the scenario that we would get in a crash 5 times as worse as 2008. We literally shut down the economy for 8 weeks and real estate increased in price. So I don't know what it's going to take to have a real buyer's market. I'll give this caveat. Some submarkets will experience reduction in price. I mean, if you guys have been doing flips in Westbury, God bless you, because you've gotten absolutely murdered over the last 2 years, right? I mean, there's just some submarkets. Meyerland, Kingwood had some major price reductions, all related to the hurricane. But I just don't see as a whole, like, the whole world is really going to end here. Let's see. How does that have to do with people taking their properties off the market because of COVID? Rob, I do agree with that. Some people don't want people in their homes because of COVID. In fact, we've bought properties. We just closed on an 8-unit down in Corpus Christi. We found out one of the tenants has COVID. All the tenants are paying except for them. So we've got some special precautions that we're taking with regards to those properties. So I think certainly people putting their houses on the market, COVID has had an impact. So what that impact is, maybe 10, 15%, I don't know. Part of the other challenge is job uncertainty. The real Texas story is not COVID, it's oil and gas. I mean, the oil and gas folks are getting destroyed right now. This is the worst recession for oil and gas ever. In fact, on an inflation basis, I want to say we're at like $3 a barrel of oil, something ridiculous like that. I mean, this is nothing compared to the crash in the 70s and 80s. Like, this is nothing. This is so much bigger. It's not even funny. But this market seems to be weathering it pretty well. Money is cheap, but not enough qualified mortgage borrowers. I agree with that, Mark. And, Jennifer could certainly speak better than I can to, the mortgage environment now versus 2008, when it seemed like if you could fog a mirror, you got a house. And now the level of scrutiny to borrow money to buy a house is so much higher. It really is. I've seen I read an article probably 2-3 weeks ago, a letter to, I want to say it was the House, whatever oversight committee is over the GSEs. And they really wanted to get rid of DTI ratios. And that they're kind of fighting tooth and nail. So we'll see if that actually happens. But again, I just don't see, like, money is cheap, but it's not easy to get. And that's keeping prices up. It really is. So let me see here. I don't see, you guys see any other questions here? I just went through the chat section. I don't see too many other questions.
So what you're saying is the more rentals you own over the next 10 years, probably going to do all right.
So here's the story that we're telling. We've got a mastermind group. There's about 40 families in there. And this is the story that not only that Rob and I are doing, but all the families that are in that group. Buy as many rental properties as you can absolutely afford. Like, you can reasonably come out of pocket, plus your reserves, be reasonable about it, right? If you can buy 10, go buy 10. If you buy 20, buy 20. Wait 5 to 7 years, sell half, pay the other half off. They are appreciating that much. I looked at our portfolio. We have a fund. We have a 506C Reg A fund. And I just recently redid the balance sheet for our fund. We have probably about a third of those properties in that fund have appreciated 25% in the last 3 years. I went into our Airbnb partnerships. In our Airbnbs, which we have a mix of some stuff that's close to business areas and that sort of thing. And then we have other properties that are located literally on the beach. Our beach properties, this is directly due to COVID, have increased almost 30% in a year. So I'm telling you guys, like, there's not this waiting and trying to figure things out. Like, don't wait. Like, this is going to be the next real estate crisis is the lack of affordable housing. It's not a real estate crash. I'm already, like, 3 years ago, I was reading this in Fannie Mae white papers. Like, there was all this discussion about housing stock. Where do we house these people? We're completely underhoused as a nation. Leases are going up. Rent rates are going up. Values in properties are going up. They're getting so expensive, and where are people going to live? And the federal government is already concerned. So Rob Trigg wants to talk about non-QM. So
define what that is to, a lot of folks out there may not know what non-QM means.
I will make it as simple as possible. There's something called a qualified mortgage and a non-qualified mortgage. A non-qualified mortgage is a mortgage that is not backed, either bought or insured by the federal government. That's the easiest way to explain it. So these are, for the most simplest way to describe it, these are private mortgages. There are funds that lend money to either investors or homeowners. They package up those loans and sell them, for the most part, to Wall Street, into what they call the secondary market. Now, QM loans do the same thing, but non-QM are private investors, hedge funds, private banks. I mean, it's all that sort of stuff out there. And the non-QM market is really the canary in the coal mine for the economy. So what happened is, right after COVID came out and everybody started talking about mortgage forbearance and tenants didn't need to pay landlords, all that nonsense, the non-QM market shrunk to zero. It went from here to here real quick. But they didn't close their companies. What they did is they just let a lot of their staff go. The company's still operating and said, we're going to take a pause on new loans. Well, after about 8, 9, 12 weeks, they started looking at the landscape and they said, wait a second, real estate's still pretty hot. We may have closed our doors too soon. Let's open back up, business as usual. And Rob can certainly speak to that, as he's seen underwriting requirements lessen, become less stringent. Rates have come down a massive amount. I remember my first non-QM email post-COVID was like, yeah, we'll do deals for you at 9%. And now they're talking 5s and 6s. I mean, literally in like 2 months, rates came down. So we're in the middle of refinancing a huge portfolio right now on non-QM, and we've seen it. So that's kind of my thoughts on non-QM. Rob, I don't know if you've got anything else that you want to share, but that's at least what we've seen as a borrower.
Yeah, the greatest thing is that we're almost back to pre-COVID standards. I'm looking at a term sheet I wrote up today, 6.35.
That's crazy. It's non-QM.
Non-QM. 70% loan to value. Now their LTV is not quite back where it was, 75, 80%. But I mean, if you're in a hard money loan or a high interest loan, private lender, whatever, and you're eating interest up at 12, 13%, why wouldn't you come out of pocket again, just to get your rate down, and that way your cash flow is a little bit better? I mean, maybe you could speak a little bit better to that.
No, that's what we're doing. It's just more cash out of pocket. It's a temporary. A lot of people think like, oh, I'm more cash out of pocket on a deal. I'm like, yeah, but just wait another year. Everything will probably be completely back. They'll do 90% LTV loans as long as it's below 1.25 DS or above 1.25 DSCR, and you'll be able to cash out 20, 30 grand. It's like, just get the money now while you can.
Yeah.
It's like so many people try to thread the needle here. I'm like, it's not thread the needle, it's casting a huge net, and just get them and go to the next one. Because what a lot of people are missing is the appreciation. It's how much these things are going to appreciate year over year. And you're probably seeing that on the appraisal side.
Oh yeah. Everything's going up. I mean, over time, over the last 4 years that I've been able to, do this, I mean, every time you turn around, an area that was like 190s in the mid 250s, mid 200s now. It's just crazy. Yeah.
And that can just completely explode your balance sheet too. And I did if you go to reHacking.com, so what Jason talked about is you could buy 10 houses, sell 5, and pay the other 5 off. At that point, most people don't realize 5 rentals, you're a millionaire. And all you got to do is let the tenant pay them off. That's all it takes. And quite frankly, with appreciation, you're a multimillionaire depending on your price point and the timing. But I did a presentation where you just buy 1 rental property a year. And it's so easy. Anyone can do that. Buy 1 rental property a year. And then we talk about the slow flip strategy, a variation of the bird, where after 3 to 5 years, eventually that property that just skyrocketed in value, like taxes start to eat you up, you sell it and just reinvest all of the capital gains and end up turning 1 rental property into 2 or 3. And if you do that over a 10-year period, you can have a massive portfolio. And then this is what happens. So even if you have skin in the game, 10, maybe 20 grand per property, your appreciation going up every single year. So Jason was talking about even 30% in some markets over a period of 2 to 3 years. Well, that's 30% of the entire property value, not just your little bitty investment of 20 grand. Like, just think about what that can do to your portfolio.
Yeah, pretty exciting.
This is why I used to tease the guys that were selling Bitcoin. Because they're talking about like, oh yeah, man, we had 30, 40% rates of return. I'm like, my worst rentals were 50%. Like, there's no reason why you can't double your money on a rental property with a little bit of equity in a year. It's like, it's not. I think a lot of people miss that math when they do the appreciation side. So Mark said, hey, we've been averaging about 6% before. Will it be higher this year? I think it will be below the median home price. If you're in a good neighborhood with a solid HOA, like 77043 Bear Creek is a great example of that. Like, I wish I bought everything retail in Bear Creek 5 years ago. That's the other thing, is investors get wound around the axle on this whole like paying retail stuff. I'm like, I didn't buy enough stuff retail there. Put 20% down, move on to the next one. 20% down, move on. I mean, literally, some of those houses were retail, were 120 grand. They're now $200,000.
You can still do that in pockets of Katy, Cypress, anywhere, Sugarland, especially Richmond, Rosenberg. You want some massive appreciation.
Oh, you just let out a little secret. Richmond, Rosenberg is a hot market. There's so much money to be made in that marketplace. If you really want to know the best areas of town, it's up 290 and then 59 South, that and the Beltway. That little pie right there is a gold mine. It's going to be some of the best. Let me put it this way. It'll be the easiest properties to manage, and they'll have the lowest risk with the highest return. Now, could you buy properties in Third Ward? They're going to do better, sure, but you have to deal with all that nonsense until that neighborhood really starts to turn around. But for the low drama stuff, that 290 right here, The Beltway and 59, that wedge is amazing. It really is.
Yeah, we have a couple in that wedge.
Yeah, love it. I think any of those outlining towns that are nearby some of the major arteries that feed in, Angleton, League City, with 288 being expanded, and then 45 North. Well, 45 North has been appreciated for a while. I think the 290 air corridor. Just look for the smaller towns. So Needville will eventually become another Rosenberg.
Oh yeah, absolutely.
All right, so we appreciate it, Jason. I don't know if you got any final thoughts or any last questions. Ultimately, the moral of the story, from what I gather here, is low interest rates, market crash. Like you already blinked, you already missed it. Not happening.
Yeah, it's gone.
It's gone. If you're on the sidelines, get in. Whether you're getting in as an agent, just making tons of money from the transactional standpoint, or buying rental properties to increase your passive income and build your wealth. We happen to do both. It's great. Pick your poison and just get to it. All right. So we'll be back here live in your living room, in all of your living rooms.
Let's not go too fast. Maybe this thing will be over with in a month.
Yeah. Yeah.
Hopefully.
Could be.
I never believed in a million years we're going to go past Easter. I'll tell you that. That was not even in the cards. And I don't know, guys, maybe we write off 2020 and we get to start all over in 2021. It's crazy. It's absolutely crazy. So, well, thanks for having me on, guys. It was great.
Yeah, thank you so much for joining us.
Appreciate it. So where can people find you if they want to talk to you more?
mrtxre.com. That's MrTexasRealEstate.com, or our very active Facebook group, the Mr. Texas Real Estate Group with Jason Bible and Robert Ruffino. That's the best place to find us.
Awesome.
All right. Thank you.
All right. Thanks, guys.
.com. Take care.
Good night, everybody.